For the first time in over 30 years, we are witnessing a significant divergence between two key financial indicators. A blue line representing consumer confidence in the stock market sits at one of its highest points in 3 decades, even surpassing the euphoric levels seen in 2000. Meanwhile, a white line from a University of Michigan survey shows the public's economic outlook languishing near the depths seen during the Great Financial Crisis. This gap reveals a deep-running problem in the financial system. People are optimistic about the stock market, but pessimistic about their personal economic futures. This paradox pushes us to understand that something crucial is breaking in the financial system, and to fix it, an economic reset is likely necessary. Let's begin by looking at real personal income growth in the U.S., which is income adjusted for inflation. From the 1960s to 2008, personal income rose steadily at about 2.8% annually, a steady trend that gave people a reliable basis for their financial decisions. This concept, called permanent income, was pioneered by Milton Friedman in 1957. However, since 2008, personal income growth has lagged behind this trend, and the gap has only widened following the pandemic. While incomes fall short of expectations, the stock market has far exceeded them, with real personal income up only about 50% since 2010, compared to nearly 300% growth in the S&P 500. Here, we see a growing gulf. People have become accustomed to disappointing income growth, yet the stock market returns have soared, creating a financial economy that is increasingly detached from people's real economic experiences. Before continuing this transformative story, if you appreciate financial cases, please subscribe to the channel and turn on notifications so you don't miss any new episodes. Now, let's discover how all of this began. To grasp the Great Reset, consider the average personal savings rate in America. Since the 1980s, savings have trended down from around 13% to just 4% today. Corporate profit margins, by contrast, have been climbing. This divergence is vital. Corporate profits are primarily distributed to shareholders, who tend to reinvest in financial assets like stocks, gold, Bitcoin, private equity, or real estate, rather than spending most of their income. This dynamic has pushed asset prices to record highs, including home prices, gold, and Bitcoin. The problem arises when this financial dynamic imbalances housing affordability. Historically, home prices have been about 4 times the average yearly household income, but since the late 1990s, that ratio has nearly doubled to 7, making housing far less affordable. Since shelter is the largest component of the Consumer Price Index, rising housing costs disproportionately strain household budgets, leaving less room to save or invest in wealth-building assets. Consequently, many households remain financially stuck. Their expenses rise, but their ability to build wealth through assets does not keep pace. The impact on public sentiment is stark. In 2000, 75% of Americans believed they had a good chance to improve their standard of living. By 2010, that optimism dropped to 50%, and today only 25% hold that belief. This dramatic decline has contributed to the highest level of wealth inequality in the U.S. since the 1920s. Looking at history, the share of wealth owned by the top 0.1% has fluctuated. After the inequality peak in 1929, wealth disparities reversed during the economic reset that followed the Great Depression, supporting a thriving middle class. This reset was triggered in part by changes in top marginal U.S. corporate income tax rates, which rose from 0% to nearly 40% in the early 20th century. Though economically painful, these tax policies helped reduce wealth inequality for decades. Fast forwarding to the 1980s, corporate tax rates fell again amid economic pressure. This spurred growth and asset price appreciation, but also reversed the earlier trend. Wealth inequality has climbed alongside tax cuts, reaching heights not seen since the 1930s. Today, corporate profits remain resilient despite pressures on consumers. We believe that the Great Reset will come when the corporate tax rate line reverses and begins rising again, likely causing painful asset price corrections similar to those in the 1930s. What does this mean for the stock market? Since markets price in future events, it's possible the market could peak before taxes begin to rise, as happened in 1929. For now, we remain optimistic about assets poised to benefit from the macroeconomic backdrop, such as stocks, gold, and crypto. These are experiencing robust inflows as money continues flooding financial markets. But there will come a turning point. When this trend flips, the market could react violently. At that moment, our strategy will shift to a more defensive posture. This story demonstrates how deeply intertwined economic policies, financial markets, and personal prosperity truly are. The challenges we face demand serious attention and thoughtful action. To close, this story shows how financial decisions and the pursuit of knowledge can transform lives and families. What would you have done in the protagonist's place? Share your thoughts in the comments. If you enjoyed this deep financial narrative, subscribe and activate notifications. Leave a like if you felt impacted, and share this with anyone who needs financial inspiration.